Matthew, it appears that you're on mute.
And I was cruising along so well. Let me start again. Thank you for interrupting, Brian. I was unaware of that. Good morning, good afternoon, good evening, everyone, once again. Apologies for starting a couple minutes late now. My name is Matthew Blake, and I head the World Economic Forum's Financial Services team. On behalf of the World Economic Forum, the Cambridge Center for Alternative Finance, and the World Bank Group, it is a pleasure to be here with you today as we provide our first glimpse into a new set of research on the impact of COVID-19 on global fintech markets. COVID-19 has had a dramatic effect on the way we interact and engage with each other, be it on a personal or professional basis. No segment of society has gone unscathed by the pandemic, and the cumulative cost on lives and livelihoods is simply staggering. Businesses globally have had to rapidly adjust to this unprecedented environment to survive. And financial technology companies, as defined by firms that provide financial products and services digitally, and predominantly by companies from outside of the traditional finance system, are no exception to this. This relatively new market segment, which sprung from the depths of the global financial crisis over a decade ago, has needed to manage the COVID-19 period not only as relatively young businesses on average, but also while dealing simultaneously with a health and economic crisis. So how have fintechs fared in this stressed environment from an operating and funding perspective? How has this segment adapted its products and services to contend with COVID-19? And what regulatory and policy requests are needed to support this burgeoning business? Shedding light on the answer to these questions, among others, is the objective of the research conducted by CCAF, the World Bank, and the World Economic Forum, which collectively canvassed over 1,300 fintechs across 169 countries. We will spend the next 90 minutes providing a first look into an intriguing set of findings, engaging with leading experts on the significance of this research, and answering your questions, and we do want this to be an interactive process. The World Economic Forum is grateful for the strong collaboration and deep expertise lent by the Cambridge Center for Alternative Finance and the World Bank Group throughout this research process. And on this note, it is my pleasure to turn the floor back over to Brian Zhang, co-founder and executive director of the Cambridge Center for Alternative Finance on the University of Cambridge Judge School of Business. Brian, back to you.
Thank you very much, Matthew. Good morning, good afternoon, and good evening to everyone. Many thanks for joining us today. At the Cambridge Center for Alternative Finance, our mission is to create and transfer knowledge, addressing the emerging gaps in the financial sector that supports evidence-based decision-making. Over the last 6 years, we have strived to elucidate the development of technology-enabled financial instruments, channels, and intermediaries that have emerged outside of the traditional financial system. We started our journey in researching digital lending and digital capital raising in one country, the UK. And 40 publications and 185 countries later, we're just beginning to comprehend and analyze the global fintech industry holistically. Fintech can be a fuzzy concept, and the global fintech industry is a bustling ecosystem seemingly in the perpetual state of change. It is a diverse space full of ingenious innovations, groundbreaking business models, trailblazing enterprises, but also often filled with noise and riddled with hyperbole. COVID-19 has introduced flux to the fintech industry, which only adds to its complexity. This research is our attempt to spotlight on the current state of the global fintech industry, to develop a working taxonomy, collect empirical data, and provide timely assessment to inform business decision-making and evidence-based regulation. The World Economic Forum is a pioneer in leading the global conversation and producing seminal research on how fintech can shape the future of finance. It has been our great pleasure to collaborate with the forum to utilize its global insights and its deep expertise. I want to thank Matthew, Mariama, and the entire forum team for their invaluable contribution and immense support. Fintech and other forms of digital financial services have also long been regarded as holding enormous potential to widen and improve the access to finance for millions of unbanked and underbanked populations, especially in emerging markets and developing economies. COVID-19 highlights the urgency to understand what is happening on the ground, where digital means could be the only viable option for many people to make or receive a payment, access savings, get insurance, or raise capital. In this context, we're very grateful for a continued partnership with World Bank Group and our deepening collaboration on fintech market and regulatory research. We're thankful for the foresight and leadership of Caroline, Anderson, Mahesh, and especially Anna. We also want to thank the UK Foreign, Commonwealth and Development Office for its foundational funding and generous support, as well as the contribution made by the Ministry of Finance of Luxembourg. We thank all of the research team, as well as the contributors and reviewers for their incredibly hard work and dedication. Finally, and most importantly, to all the fintech firms who graciously took time out of their busy schedule under the most extraordinary circumstances to participate in our research, as well as more than 100 fintech industry partners who supported our survey. We thank you very much indeed. This report is for you, and we hope you will find it timely and useful. Thank you. And I will now pass the virtual mic to Anderson Caputo Silva, Practice Manager at the World Bank Group, to deliver his opening remarks.
Thank you very much, Brian, Matthew. Good morning, good afternoon, good evening to all. Fintech has shown its potential to close gaps in the delivery of critical financial services to households and firms alike in emerging markets and developing economies with significant financial inclusion impact. The COVID-19 pandemic is likely to accelerate the use of fintech as it facilitates the remote provision of financial services. However, fintech firms comprise a wide taxonomy of firms that deliver very different financial services based on different business models, from mobile money to digital payment solutions, lending and capital raising platforms, to fintechs that provide supporting services such as credit scoring or digital ID solutions. Thus, for the World Bank Group, it's critical to gain a deeper understanding of the impact of the pandemic across different verticals and also across regions in order to better tailor the advice that it provides to country authorities. The Global Rapid Market Survey has supported this objective. It provides an industry view of key topics with unprecedented level of responses and robust representation across all the major verticals, across all regions, and across countries with different levels of economic development. The World Bank Group appreciates the partnership developed with the Cambridge Center for Alternative Finance and the World Economic Forum, which has been instrumental to achieving this level of support from the fintech industry. We also hope that the preliminary insights provided in this study can be useful to government authorities as they seek to identify the type of actions needed in their respective jurisdictions to reap the benefits of fintech, while ensuring that risks to consumer protection, integrity, and financial stability are well managed. The World Bank Group stands ready to continue supporting countries in these efforts. And then with that, let me pass the floor back to Matthew, and I look forward to a very interesting presentation discussion of the survey results. Thank you.
Anderson, thank you very much for those remarks, and Brian as well. So we are going to roll up our sleeves now and go through some of the key findings of the survey and the subsequent report that will come out over the coming days. We have two individuals with us here that have been seeped in this process from the get-go and very well versed in the outcomes of the survey. So first we have Mary Emma Barton, who's a research and analysis specialist at the World Economic Forum. And we have Tanya Ziegler, lead of global benchmarking for the Cambridge Center for Alternative Finance. I turn it over to you in your capable hands to walk us through some of the key findings here. Thank you very much.
Thanks, Matthew. As Matthew mentioned, my name is Mary Emma, and I'm going to walk you through some of the high-level findings and empirical data from the FinTech assessment. But before we get into the weeds and look at the data, we wanted to take a quick moment to reiterate the goals of the study. This research really had 3 goals. First, we wanted to figure out the impact of the global pandemic on fintech markets. We really sought to understand how fintechs are performing based on their operating model and jurisdiction, among other criteria. Second, we studied the responses of these organizations in shifting their products and operations throughout the pandemic. We wanted to know how these companies are dealing with remote working measures in a more digitized economy. Finally, our last goal was to identify issues fintechs are facing on a regulatory front. With this context in mind, over the next part of today, we are going to go over the methodology for the research, look at market performance by geography and vertical, and then quickly touch on fintech performance in areas with stringent COVID-19 lockdown measures. From there, I'll hand the floor over to my colleague Tanya, who will go over how fintechs have adapted in the wake of COVID-19 and issues in the regulatory and policy spaces. Let's get started. As you can see from this map, we truly canvassed the globe when conducting this survey. As Brian and Matthew mentioned, we received responses from about 1,400 fintechs with operations in about 170 countries worldwide. In the end, the study was one of the largest of its kind. We received the greatest number of responses from the US, UK, India, and Singapore, which are markets with particularly developed and innovative fintech operations. Next slide. Really quickly here, we can see the verticals ranked by number of responses. So we received the greatest number of responses from the lending, payments, and digital capital raising spaces, which made up more than half of the sample size. About 80% of the firms we surveyed were retail facing, whereas the remaining 20% were classified as market provisioning. For some context, we defined retail facing as firms serving households, consumers, and MSMEs. These would be the digital payments, lending, and insurtech firms. Market provisioning are firms that support back-end infrastructure or other key functionalities in fintech. These would be the digital identity firms and data analytics firms. Next slide. On this slide, again, we see the verticals ranked by number of responses. But here we are looking at transaction volumes in the first half of 2019 compared to the first half of 2020. Based on this, we can see overall the global fintech market is growing, with about 12 out of 13 firms reporting year-over-year growth for the first half of 2020. Digital payments companies, as you can see, are performing quite well, with about 20% growth in the first part of the year. This performance is likely a product of the rise in digital channels for payments and remittances throughout the pandemic. From a health perspective, digital payments particularly can be contactless and can be a safer way of transacting in person rather than exchanging cash and germs. We actually see this in Kenya, where the central bank doubled the daily transaction limits back in March to encourage digital payments. They ended up extending this measure in June with the hope that avoiding the use of cash would help contain the spread of the virus. Measures such as this may have contributed to this increased adoption of fintech. We should also point out that digital lending is underperforming compared to the same time period last year. The vertical not only had a decrease in transaction volumes, but also had about a 10% rise in the default on outstanding loans. This is fairly expected because digital lending, like bank lending, is procyclical. So with so many businesses facing turbulent economic times, it may be more difficult for them to take on additional debt, which would lead to less transactions overall in this space. This is the only segment where we did see a decline in the number of transactions year over year. Next slide. From a regional perspective, most regions did grow by transaction volume in the first half of 2020. The outlier here being the UK, where we saw about a decline of about 3% year over year. It's important to highlight here we are comparing regions based on their performance in the previous year rather than region versus region. So this helps explain the significant uptick in transactions in the Middle East and North Africa over the first half of this year. In MENA, fintech and financial services in general are still at a relatively early stage of adoption, giving the firms in that area a bit more room to grow. One fact here is that across that region, there's about 5% penetration in insurance coverage. So this provides firms with a huge opportunity to grow their customer bases and promote financial inclusion. As you can see, also other markets saw fairly stable growth despite the pandemic. Next slide. In separating out advanced economies with emerging markets and developing economies, we see differences in performance by transaction volume, as well as difference in the percentage of new customers and retention rates of existing customers. Overall, the emerging markets and developing economies do outperform the advanced economies in our year-over-year analysis. This could be attributed to several factors, including the lack of legacy banking infrastructure in developing economies, which would make it easier for firms to grow digitally and increase the ability of users to adopt digital financial services quickly. Next slide. As you can see here, we also looked at fintech performance by COVID-19 lockdown stringency. To determine this, we leveraged the Oxford COVID-19 Government Response Tracker, which rated countries on lockdown measures, taking into account factors such as restrictions on mobility and school closings. In this analysis, we assigned each of our respondents with the corresponding rating from Oxford and created 3 equal quantiles of fintech firms. This allowed us to create a policy proxy for severity of lockdown. As you can see, we did see the largest increase in transactions by both volume and number, with markets in the greatest lockdown measures. The higher the COVID-19 stringency, the higher the adoption of fintech services. The increased adoption is not necessarily caused by the pandemic, but there is a direct correlation between strict lockdowns and the increased adoption of fintech services. We see this trend consistently across verticals. So firms in high stringency jurisdictions reported a much faster growth rate compared to those in areas with less restrictions. That is not to say these firms did not face challenges. Fintechs in jurisdictions with stricter lockdown measures did have a high cost of operations. Even so, these adoption rates suggest that fintechs were able to adapt and help their users transact digitally when in-person means were not possible. Again, increased adoption is not necessarily caused by the pandemic, but we do see a correlation between lockdown stringency and increased fintech adoption. With that, I'll hand over the floor to my colleague Tanya, who will walk you through how these fintechs have adapted in the wake of the pandemic, as well as the regulatory issues they are facing as of late. Tanya, all you.
Thanks so much, Emma. If we can go to the next slide. So the fintechs that responded to this study were fairly responsive when it came to implementing changes to their existing products and services. Just over 2/3 of firms reported making at least 2 or more changes to their core offerings in response to the pandemic, and a further 30% were in the process of implementing changes. Retail-facing fintechs, and in particular digital payment, lending, and banking firms, were among the most nimble verticals when implementing changes to their offering, with more than 78% of these firms having already made a change. When we observe the entire data set, we see that some 30% of firms have actively made amendments to their qualification or onboarding criteria. In fact, more than half of all digital lending platforms have implemented this change. After qualification criteria, the changes that firms tend to make are positioned with respect to their pricing, and these were among the top tweaks. You can see that fee or commission reductions, payment easements, and fee and commission waivers were adjusted by at least 1/4 of all of the firms that responded. We can go to the next slide. The study also wanted to understand the variety of new products, services, and features that firms implemented. About 60% of the panel introduced new products or services. Interestingly, value-added non-financial services was among the highest new category, especially for firms that could be categorized as retail-facing. In this case, we see that financial technology firms are introducing a variety of information-based services with an emphasis on placing financial education and literacy at their core. Particularly, digital lending firms have placed the greatest emphasis on this product category than compared to any other vertical. We do have an interesting example. A digital lending firm in India recently created an add-on portal to help low-income female entrepreneurs understand the financial products that their platform offers. Some of the other verticals placed emphasis on different products and services. Of note, we found that 40% of digital capital raising platforms indicated that they had been hosting a COVID-19 specific funding, with these crowdfunding campaigns going to support relief efforts. Enhanced fraud and cybersecurity features is arguably one of the most critical changes that we have seen. This chart tells us that just shy of 30% of all fintechs have already enhanced their cybersecurity features, with a further 12% in the process of doing so. In particular, retail-facing fintechs in the digital payments and digital banking arena were amongst the highest to have already adopted such new features, and at about 40%. And on the market provisioning side, we saw that almost half of all digital identity firms had already implemented new cybersecurity features, and a further 40% were in the process of doing so. While this is certainly encouraging to see so many firms placing a focus on cybersecurity, it does beg the question, has enough been done? The CCAF and the World Bank recently published a regulatory-focused companion study, which found that 78% of regulators regarded cybersecurity among top risks. We can go to the next slide. To support various COVID-19 related socioeconomic relief measures, fintechs may play an active role as delivery or implementation partners alongside government. This study aimed to show the extent to which financial technology firms had engaged in supporting such activities or their willingness to do so. To date, there is limited involvement by fintechs in the delivery of COVID-19 related relief, despite significant willingness to do so. More than a third of the firms reported a willingness to participate in the delivery of one or more COVID-19 related relief measures or schemes. This demonstrates strong interest, yet participation rates are relatively low. Now, certainly, there are high-profile examples of fintechs functioning as delivery partners. Notably, a select few UK lending firms have issued loans under the Coronavirus Business Interruption Loan Scheme in the United Kingdom. Yet, fewer than 10% of firms globally have been able to serve in a similar fashion, with only 7% delivering relief to MSMEs. Low uptake from corresponding governments in positioning fintechs as a delivery partner may relate to the fact that many governments are facing general supply issues themselves. Some may not have the capacity or the resources to provide relief or stimulus funding. Similarly, examples of fintechs that have functioned in this manner are those that have reached relative scale. The fintech ecosystem in general is still relatively nascent, so despite a willingness to partner with government, realities related to their stage and growth may make this more difficult in the short run. We can go to the next slide. Fintechs also require assistance from their primary regulatory or supervisory relationships. This study wanted to understand the key regulatory support mechanisms that firms needed in order to weather the storm. It is worth noting that many of the measures listed here are not fintech exclusive, but are more generally applicable to financial services. When we look at the fintech responses in aggregate, we see that core regulatory activities relating to their customer or client onboarding processes were of paramount importance, with firms reporting already using interventions related to eKYC, to simplified customer due diligence, and to support for remote onboarding at some of the highest levels. That said, on balance, most fintech verticals were not yet recipients of regulatory support. However, the recent regulatory study, to which I alluded earlier, found that 37% of regulators had brought forward fintech-specific interventions, and that these were directed at digital payments. As such, a caveat relating to digital payment firms does exist, with these firms reporting already taking advantage of regulatory measures to a much higher extent than any of the other verticals observed in this study. Nevertheless, urgent need for regulatory support was far more pronounced. Overall, most firms reported urgently needing faster authorization for new activities, followed by streamlined products and services approvals, And then, of course, those that are facing that client onboarding side, the simplified customer due diligence, remote onboarding, and so on. Now, interestingly, firms in emerging markets tended to already utilize regulatory support more than those in advanced economies. Yet they also reported urgently needing support at much higher degrees. The study found that nearly half of all firms in emerging markets urgently needed regulatory support of one kind or another, with particular emphasis placed on faster authorization, with just shy of 50% needing this urgently, and streamlined approvals of new activities, 40%. When we look at lockdown stringency, this is another useful way to measure regulatory usage and need. For firms located in high stringency markets, 21% reported currently benefiting from regulatory support, and a further 45% reported urgently needing support. This suggests that regulators were more likely to extend support measures in countries where lockdown measures were more severe or in emerging markets. We can go to the next slide. The study also wanted to shed light on how financial technology firms are utilizing or might utilize regulatory innovations like sandboxes, innovation offices, and hackathons or tech sprints. When considering the overarching environment, fintechs overall have been less reliant on innovation mechanisms when compared to the aforementioned core regulatory or supervisory interventions. Yet the caveat is that firms in market provisioning facing activities, and in particular, reg tech or enterprise technology firms, were amongst the highest to use or urgently need regulatory innovations such as these. Greater divergence on use and need also appear when we consider these three interventions in terms of income level groupings. Firms located in emerging markets tend not only to utilize such innovations more than their advanced economy counterparts, but they also urgently needed access to these innovation initiatives more, outstripping needs sometimes by nearly double. This may relate to the fact that the fintech ecosystems are still in flux within many emerging markets, with yet to be established bespoke fintech regulation or clear parameters. We can go to the next slide. As fintech firms deal with day-to-day operational challenges, this study sought to understand how firms were dealing with factors that impacted their platform operability, their costs, and associated operational risks. In aggregate, fintech firms noted slight increases in platform downtime, in agent partner downtime, and the number of unsuccessful transactions. This was amidst increases in costs relating to onboarding at an average of 8% and data storage at an average of 11% for the entire data set. A clear divergence appears, however, when we look at the operational challenges against lockdown stringency. Fintechs operating in countries with high stringency measures reported greater operational challenges and incurred higher costs. Fintechs in high stringency markets reported markedly higher instances of platform downtime and agent partner downtime when compared to those in low and medium markets. Similarly, costs were higher for high stringency markets, particularly as they related to onboarding costs, more than double that reported by fintechs in low stringency jurisdictions. If we consider cybersecurity risk on its own, we see that firms in high stringency markets particularly noted an increase in their perception towards cybersecurity risk at 17%. This is more than double than those in lockdown markets. Firms located in emerging markets also reported some of the highest perception towards cybersecurity risk, reporting at around 19% increase. We can go to the next slide. In general, fintechs globally reported a downward revision of 4% with respect to their fiscal year 2020 turnover targets. Firms in advanced economies revised this target down by 7%, while those in emerging markets reported a 1% drop. Fintechs also reported an increase in their overall headcounts, with FTEs rising by 5% year on year, and in emerging markets, this rose by as much as 8%. When we consider this in terms of lockdown stringency, we are able to glean more insights. As we recall from earlier in this presentation, Fintechs in high stringency markets reported demonstrably higher increases in their transaction volumes, greater numbers of customer acquisition and of retention compared to those in lower medium markets. In general, firms in high stringency jurisdictions reported unchanged revenue targets for 2020, compared to the 8% drop reported by fintechs in low stringency jurisdictions. Firms in low stringency jurisdictions also reported an average 19% drop in their FTEs, whilst high stringency markets reported increases nearly double the fintech average. This may suggest that firms in high stringency jurisdictions are able to capitalize on market opportunities presented by COVID-19 to a greater extent, while those in low stringency markets have seen a dip in their business. I would be remiss not to mention fintech's perception towards their capital reserves or fundraising outlook when discussing financial position. Despite aggregate increases in transaction volumes and net increases of headcounts, rising operational costs are likely impacting firm profitability. On balance, the study found that more than 50% of the fintechs in this study indicated that the pandemic had caused a negative impact on their capital reserves. 40% of the surveyed firms also indicated that their current valuation had declined as a result of COVID. And finally, over a third of all of the firms noted a negative impact on their ability to fundraise in the future. This study provides a rapid assessment of the initial impact of COVID-19, but we still have a lot to learn. The performance of the fintech industry is highly uneven across verticals, across geographies, and certainly when we consider severity of lockdown or their income level status. In the coming year, the CCAF, the World Bank Group, and the World Economic Forum is planning on conducting further comprehensive and in-depth research into the longer-term impacts of COVID-19 on this industry, with the hope of building upon the baseline that we have provided in this study. The full report is going to be released on December 3rd on the CCAF publication page, and we look forward to your feedback and to your thoughts. Thank you so much for your attention. And with that, over to you.
Tanya, Mariama, thank you so much for that comprehensive overview. It is clearly a rich set of findings, unique in all aspects, and terrific presentation there, delving through some of the numbers. We are going to continue the discussion here. We are very fortunate to have 4 renowned specialists with us today, very diverse backgrounds, which I will introduce in a moment. Before doing so, however, I'd like to just remind everyone that we do want to make this panel an interactive one, and we are using the Slido tool, and we're about to put up the QR code, et cetera, here. And we would love to hear from you in the Slido function, your questions. We have a team on the back end that will try to help us sort through things, but we do want to incorporate your questions here into this conversation. So without further ado, I'd like to introduce our 4 panelists here. I'm going to start with Blythe Masters. Blythe is an industry partner at Motive Partners, where she sources and executes investment opportunities with a focus on thematic strategy, development, and value creation on behalf of the portfolio companies. Prior to joining Motive Partners, Blythe was CEO of Digital Asset, which in 2018 was named one of the most innovative tech companies to watch by the Wall Street Journal. Before Digital Asset, Blythe was a member of the Corporate and Investment Bank Operating Committee and Firm-wide Executive Committee at JP Morgan. Blythe, thank you so much for being with us here today.
Thank you.
Next, I'd like to introduce Bob Wardrop. Bob is a director and co-founder of the Cambridge Center for Alternative Finance. As an economic sociologist, Bob's research areas of focus cover why channels and investments of finance emerge outside of the traditional financial system and how this impacts regulators, incumbent institutions, and consumers. Prior to starting his academic career in 2010, Bob had an international career as a professional investor, most recently at one of the largest privately owned companies in the United States. Bob, great to see you.
Thank you.
Next, I have Ana Fiorella Carvajal. Anna is a lead financial sector specialist at the Finance, Competitiveness, and Innovation Global Practice of the World Bank Group. She has over 25 years of experience in financial sector issues with a focus on capital markets development, regulation, and supervision. She currently leads the World Bank Group's work on the importance of preconditions for capital market development, as well as the use of capital markets and SME financing, both critical pieces there. In addition, she has had a responsibility for the assessment of the largest capital markets in the world as part of the financial sector stability assessment that is run jointly between the World Bank and the IMF. Anna, great to see you. Thank you very much for joining us.
Thank you. Delighted to be here today.
And finally, we have John Frost. John is a senior economist at the Bank for International Settlements in the Innovation and Digital Economy Unit. He conducts policy-oriented research on fintech and digital innovation. He has written extensively on fintech credit, big tech in finance, technology, and inequality. Previously, John worked at the Financial Stability Board, Netherlands Bank, VU University in Amsterdam, and in the private sector in Germany. John's research covers a host of different topics, including financial stability and macroprudential policies, international capital flows, and central banking. John, great to see you. Thank you so much for joining us as well.
Thank you, Matthew.
All right, terrific. We're going to get straight into it here. Anna, I'd like to start with you. And I think one of the most interesting findings coming out of the survey is the fact that fintechs on average actually have fared quite well in the first and second quarter of this year. And they were able to grow their customer base and transaction volumes as a result of good performance. Peel back the onion a bit here. How were these firms able to do this? What were the major drivers of growth for these companies?
Very good question, Matthew. Let me say that when we look at these trends, there are fundamentally two sets of factors that have influenced growth in emerging markets. On one hand, we have what I would call macro factors. We have demographic trends that favors online transactions. If you see, we have 85% of the global population is in emerging markets, 90% of the population under 30 is in emerging markets. So this provides a sweet spot for online transactions at a moment that many emerging markets are growing their internet penetration, their mobile penetration, and with incumbents that have not been subject to competition and therefore were charging high fees, high commissions. So this provides impetus to the revolution of fintech. And the other big factors surrounded this are more on the government policy side. There has been a concern about financial inclusion. In emerging markets, 65% of adults lack access to basic accounts that allow them to send or receive payments. And then we have fintech that have been able to lower costs and make viable providing services to underserved populations. So then what we have is many governments in emerging markets now more forcefully supporting the entrance of fintech. And I would say that the first wave of this that we had seen was on digital payments, and we still see it. And if you've seen the survey, this was a sector that grew a lot. And so we have seen emerging markets supporting this, and especially during COVID, as Mary Emma mentioned, there were a lot of emerging markets also pushing more for digital payments. And then the second wave that we hope to see in emerging markets is this expansion of the use of fintech to other sectors like capital raising. And again, what we are seeing is more and more governments in emerging markets implemented policies and actions that are supporting fintech. So when we look at these two together, what we see is then there are countries where there's tremendous, from a business perspective, tremendous opportunity to grow from a lower base. And therefore the percentage changes might be more in emerging markets. And again, governments that are pushing the envelope to get us there.
Thank you, Anna. Yeah, lower costs, greater financial inclusion, the top-down approach from governments where there's a national agenda, pushing for fintech adoption, all excellent points. Blythe, I'd like to come to you next. Another fascinating piece that came out of the work was the fact that 90 plus, give or take, % of the fintech surveyed reported either having launched a new product or service during COVID, or these firms were in the process of getting one of these products or services off the ground, which is sort of a remarkable fact on its own. What have been some of the developments in products and services during the COVID environment that fintechs have offered? What have you seen that's new and original, Blythe, from your vantage point?
So the answer is a lot of things, a lot of change. But before I jump into that, I want to add to Anna's prior comment, which is that in the United States, not typically referred to as a less developed economy or an emerging market, it's estimated that there remain about 55 million people, or 22% approximately of the population, that are either completely unbanked or underbanked. And so the implications of what has been happening during the COVID era in terms of very rapid acceleration of digital adoption has two potential consequences that we need to think about. One is whether easier access to digital financial services helps address that segment of the population by lowering the costs and barriers to entry, or whether actually it might exacerbate the problem because of lack of digital inclusion and digital integration into society, for example, due to lack of access to high bandwidth internet, mobile and other computer devices. I don't have a good answer to that question, and I suspect that there are some that are being more left behind, and there are others that are being helped by the developments. I would say that obviously the high level observation is that COVID-19 has accelerated digital adoption across the board, not just by consumers, although we all see it by consumers when our grandparents are suddenly shopping online for the first time, but also by enterprise. And the impact of that has been probably to bring forward by at least 5 years, some would say more like 10, the degree of digital adoption that was already a very well-established trend pre to COVID, but certainly has been sped up due to lack of alternatives and having more time on hands, and due to the operational challenges created by working from home and the like. Three of the most impacted sectors, which showed up in your survey, have been payments, lending, and wealth management. In the payments sector, obviously, the usage of cash has dropped, the usage of alternatives has risen, and contactless mobile payments made enormous strides. I saw a statistic in the UK that actually Europe as a whole, 1 in 5 adults used contactless mobile payment for the first time during lockdown. It's very hard to argue that that would be a trend that reverses itself after lockdowns come to an end. We've seen key product innovations by fintechs. Number one, enabling account-to-account payments. Obviously in Europe, open banking helped drive that, making it much cheaper and more secure means of access to financial accounts without sharing card details or sharing account details, which obviously has spoken to the increase in concerns around fraud. Second thing is the introduction of QR codes at the point of sale, supporting things like ordering at your table, and unattended payments in the hospitality sector, which was obviously necessary for takeouts or eating in less densely populated conditions. And then increase in the use of digital wallets, an increase of about 20% in the first half of the year alone in the use of digital wallets like an Apple Pay or a PayPal or a Cash App, that are innovations that are building in new value-added services like cashback and the like, which all have enjoyed extraordinary accelerations. Second area is wealth tech. This is really radically changed. Digital engagement by individuals has increased by as much as 10 times during the course of 2020 relative to the prior year across leading wealth managers. You've seen the extraordinary progress of new platforms, the likes of Robinhood, that are now seeing daily trading volumes driven primarily by retail investors, that exceed the volumes at the traditional public incumbent brokerage firms. And about 25% of total trades in the second quarter were done by retail investors, a big increase over prior periods. The wealth tech firms have had to respond very rapidly. Those in the B2C space have had to address, essentially the need to mature, become more resilient, more compliant, and tackle security and scalability issues. And on the B2B front, solution providers have had to pivot to serve a whole new generation of users that are much more digitally demanding and digitally enabled and in need of more efficient post-trade operations in particular, given the difficulties of having their operational capabilities dispersed and working from home. Last area I'll touch on is in digital lending technology. This is the area where obviously because of the impact of unemployment, underemployment on income, where balance sheet intensive business models or risk intensive business models have suffered. And traditionally bank technology focuses on relatively higher value, lower volume lending activities. We've seen a shift to lower value, higher volume lending activities, including at the point of sale. So, you go to buy something online now and you get the option to pay for it in 4 easy installments from, a Klarna or an Afterpay. Big change in the way in which online lending or lending to the consumer is occurring. Clearly, those enterprises that had a digital strategy and a digital first engagement model are those that actually benefited during COVID versus those that lost touch with their borrowers, are really struggling with understanding what the long-term credit consequences of the environment are on their portfolios, with higher write-downs, greater difficulty in procuring capital and financing themselves. So real bifurcation between those that are using digital engagement channels, both to connect with customers and, more importantly, to assess their credit worthiness versus those that are not. So those would be the three big areas that I would point to in terms of new product innovations and responses to the changing environment.
Blythe, thank you very much. A terrific perspective there. I want to come back to the stickiness of this digital adoption point that you made, and specifically, Bob, I know you've done a lot of work around digital payments, particularly mobile money, and we've seen considerable increases in transactions in the digital space there. Do you foresee this as being a permanent shift in the way that people transact? And if you were to provide a recommendation, many of the people watching here run firms that are heavily involved in this space, what would be your suggestion for fintech firms to retain this client base that has been so prominently growing over the last 10 plus months here?
Well, I think it's hard to argue with the points that both Blythe and Anna have made regarding this not being a temporary shift. So I'm not going to kind of get into kind of why that might or might not be. I think the direction of travel here is pretty clear for everyone. I think it's important to understand, though, really what's driving it, because the aversion to cash created kind of this window of opportunity for the behavior shift, right? You had people shifting preferences, but that's not the only thing that was going on. That shift in preferences was supported, as we've seen in the data, by some regulatory moves. I mean, look, I think everybody realizes that when Libra showed up, every regulator and every central banker had to kind of rethink their whole approach to payments. That was a big moment, and it's still going on, right? And Libra may appear. So that's going to have a huge impact, because it gets at the third factor, which is, I think, this very important shift to the horizontalization of financial services, or the embeddedness, particularly of consumer financial services in other verticals. If we think about kind of the S&P 500 and classification of tech firms, which were the tech firms in that classification 5 years ago, a lot of them aren't classified as tech anymore. Why? Because tech is embedded in everything. And so a lot of those firms that were formerly known as tech are reclassified as communication firms today in the S&P 500. Now, you take a look at finance and you start to think, as Blythe pointed out, I'm making a purchase and I have an offer of a loan, and the payments being facilitated, the loans being facilitated, but it's an e-commerce provider that's doing it. And so as you start to see this embeddedness emerge, if I was running a firm today, mobile money, whatever operation, I would be thinking about a world in which payments are free. Because that becomes the challenge. Part of the driver here in growth, as we pointed out in the data, is significant number of firms have reduced their fees. And when COVID's finished, you're not going to be able to raise, realistically, you can't raise fees. So you have to drive volume. But even driving volume may not be enough if someone else is prepared to give away the payment because it's part of a platform strategy. They're looking at this more holistically in the payment with respect to a broader service offering. And I think that gets into a whole different frame if you're a payment provider connected with payments about how you approach the market. You've got to think about APIs. You have to think about the ecosystem. You have to think about how to reduce the risk of commoditization if the payment becomes free. So I think we're not going back to where we were. And I think the regulatory world is still very concerned. I think John Frost cross-border payments, John's written on this, central bank digital currencies. The path of travel to make payments easier, I think is clear, easier and cheaper. And I think it's coming pretty fast. I'll stop there.
Thank you, Bob. We are not going back to what we knew. And I want to come to you, John, because that poses a number of really fascinating questions here. And certainly the pandemic has underscored that digital financial services, there's some major gaps there between higher and lower income individuals, gaps between folks across gender and also age accessing digital financial services. So do you feel that technology will continue to drive convergence among these groups, or are we setting ourselves up for more of a structural pain point here going forward? John, let us know your thoughts.
Yeah, thanks, Matthew. So just to start off, I'd echo some of what Blythe said, that inclusion in financial services is not just an issue in emerging market and developing economies, it's an issue in societies around the world. And the pandemic, unfortunately, has made that very clear. In a number of countries, governments have tried to conduct government-to-person payments to reach individuals. In some countries, they've been able to use new digital methods to do that. In other countries, they've had to rely on prepaid cards or on paper checks, which have gotten lost in the mail or stolen. So, this move to ensure that everyone has access to financial services, I think that's gotten more attention in the pandemic, and certainly there's a public awareness that inclusion and access are very important. But there are concerns that the move to digital on its own may not be sufficient to bring people into the financial system. So technology can be part of the solution, certainly. I mean, we discussed and heard in the report also about remote onboarding and some of the really impressive progress that's been done in opening accounts for people remotely during the pandemic. But there is this risk of a digital divide. So I think the policy priority is technology can help if it's widely diffused. And we've done work at the BIS as well. So in cooperation with Sharon Chen from EY, we've looked at the FinTech gender gap. So specifically whether FinTech can help to close the gender gap in financial services between men and women. And what we find so far from the survey evidence is that in nearly every market surveyed, women are actually less likely to use FinTech products and services than men. And women also report being more concerned about their security when dealing with companies online, being less willing to share data in exchange for better offers on financial services. So clearly there is some work to be done to make sure that FinTech offerings are inclusive and that they serve all customers, men, women, higher income, lower income, and people with different preferences and views toward their data privacy and toward the adoption of digital technologies.
Thank you very much, John. I want to switch gears a little bit and talk about the involvement of FinTech in the provision of relief. So the intersection between government-related COVID relief and the FinTech sector. One of the pieces that have come through in the survey results is the fact that there haven't been many examples across the globe of that interconnection being strong, where FinTechs have been used as a delivery mechanism for relief. I want to ask Anna, perhaps, was that a missed opportunity from your vantage point? Do you foresee perhaps as further relief is considered that fintech will be brought into this this equation a bit more forcefully?
Thank you, Matthew. First, let me remind the audience, as Tanya said, that not every country, not every government in every country had the same capacity and fiscal space to implement relief measures. So we need to take that into consideration when analyzing the findings of this report. That said, I think that depending on where we are, whether emerging markets or advanced economies, we can say that the limited use of fintech firms is more a response to the level of development of fintech or a missed opportunity. When we look at emerging markets, we have a fintech sector that is at an earlier stage. So one needs to factor that into consideration. That said, what we did see is that in many emerging markets, governments did use particularly the fintechs in the digital payments area to try to channel relief to the population, because in many cases, the households did not have formal accounts in the formal financial sector. So they did use these partners in the digital payment space. And we have examples from countries like Zambia, Uganda, Peru, Colombia, Paraguay, that did use the partners in the payments, the wallets, to get to the households and deliver the support. And then switching to advanced economies, one could argue, and I should have said before that the opinions that I'm giving are personal and don't necessarily reflect the opinions of the World Bank. One could argue that at least in advanced economies, there has been a little bit of missed opportunity because we see their relief programs, for example, the lending programs to get to small businesses and firms, where initially, at least in some of the advanced economies, they were channeled mainly through the banking sector, through incumbents. And one could argue there could have been more effort initially to include them. And there were concerns about the fact that banks were not able to provide the speed and the turnaround necessary when at the same time during COVID, all these small firms were needing of support. But what we are seeing, at least in cases like UK and the United States, is that although later in the game, the government authorities are opening the channels and bringing fintechs into the provision of this relief, for example, in this case, to be partners in the provision of lending. So what we're seeing is now more awareness of the possibility that fintech provides, because again, I had made a point before of lowering costs, but it's not just lowering costs. They are also, their skills make them potentially faster in dealing with these applications for lending. So there are certain opportunities that come from opening the channels to fintech that governments in advanced economies are realizing and are opening. Not sure whether all what could be, but at least they are aware of this and changes are being made.
Thank you very much, Anna. Great points there. I just want to remind everyone we have an ability to ask questions via Slido, and we're putting up again the instructions on how to do that. We've already had a number come through. I'm going to try to feather those into this conversation as we move forward. Let me come to some of the risks here of greater digitalization. So John, maybe I turn this one to you. It's an area of interest of your research. So the recent survey pointed to the perception of risk related to cybersecurity as increasing, and the number we have on is 15% year over year among fintechs. How do you think cyber risk has changed in this pandemic period? And do you see this perception of risk continuing to grow among the fintech cluster?
Yeah, so this was a really relevant insight from the report that the perceptions of cyber risk are increasing. And certainly, also on the policy side, we've been concerned that cyber risks may rise as organizations move to working from home and as cyber criminals attempt to profit from the uncertainty around the COVID-19 pandemic. But the study actually is able to quantify that change in perceptions. And I think that's a really valuable contribution to the discussion that offers data that can help us to better assess what firms are thinking and whether this is in fact increasing relative to the pre-pandemic period. So this increase in the perception of cyber risk, I think, is broadly consistent with other evidence that's out there, including some work that co-authors are working on at the BIS. We've seen, based on other survey evidence, that the financial sector has been relatively more hit by cyber incidents than other industries during the pandemic. And to some extent, that's logical. I mean, the financial sector is also an industry that has a higher propensity to move toward working from home. You can also see that in the financial sector, there have been a number of incidents explicitly related to COVID-19. For instance, phishing campaigns claiming to be from the World Health Organization and other attempts, to profit from the uncertainty. And going forward, central banks and regulators have expressed concerns in many cases that cyber attacks could be associated with systemic risk, so that they could be could lead to systemic implications and to broader distress. And there's a great deal of policy work being done in the area. I'd just note that the BIS is also contributing, trying to coordinate the discussion between central banks around the world, recognizing that cybersecurity is a global public good.
Thanks very much, John. I want to come back to this point that was raised earlier. Blythe had mentioned the fact that much of the trading activity in today's environment is led by retail. There's a really interesting question around as fintech adoption increases and more customers use digitalized products, what efforts are being made to protect the relatively unsophisticated or financially vulnerable customers? We've sort of hit on this topic from a number of different angles. Bob, I was going to ask you what your thoughts are. How do we protect those within the financial services system that are most vulnerable to being exploited or to perhaps making perhaps not the best financial decisions at the click of a button?
Well, it's interesting, and I would invite some of the other panelists to chip in. So I'm going to be deliberately short because I think this is an area that I think is being underserved right now. And so if we step back and we think, it was interesting how you phrased the question, because I don't think it's about making financial decisions as much as maybe it was before. It's about how do I interact with the technology? So clearly we're here talking about the broad area of the gap in financial literacy. And what financial literacy was 5 years ago was, what's an interest rate, right? Helping me to make better financial decisions. At least that was the aim. Let's leave aside how effective a lot of those programs have been, okay? Because that's been a big challenge. But I think what now is really, really important is technology literacy. So, I'm now, how do I protect my password, right? And what am I? So it's more about digital financial services literacy than it is about financial literacy. I'd make that point. But I think also regulators can't act on what they can't see. And what you've got is this explosion of kind of digital activity going on. And I think some regulators would suggest that their visibility on what's going on is challenged. And so there needs to be tools brought in. I would point to, for example, a chatbot that the Philippines introduced, where consumers can very easily text in a concern about a vendor or a question, and then you have machine learning and natural language processing in the regulator that's sorting and filtering, so they can actually improve their visibility to respond to what's effectively being crowdsourced by consumers. So it's not just about digital financial services literacy, it's also about enabling regulators to maintain visibility or increase it in a digital environment. I'll stop there and hopefully have some other comments.
I want to invite others to come in on this. Blythe, I see that you went off mute there. Would you like to continue on Bob's comments?
Yeah, no, I agree with that. I think I too would concur that this is a space that is being underserved. I think the dimensions or vectors of attack or vulnerability for individuals are increasing as the array of different financial instruments or perhaps financial delivery mechanisms are expanding. On the one hand, there's a certain quicker, cheaper, faster, easier appeal to digital wallets and other similar concepts. But there is no doubt that actually there are more complexities and sophistications in terms of how do you handle your security environment around such things. Everything ranging from, you know, how do you address them in your will, you know, to the vulnerabilities that you incur day to day life. I also don't think it's a coincidence that, you know, one of the most recent, you know, newly minted unicorn status firms is Chainalysis, an enterprise blockchain firm that is specializing in essentially helping governments and financial firms and exchanges and institutional investors and others essentially defend and prepare for a world in which digital engagement is in a whole new league. So I think it's an area also where regulators are playing catch up, and where many of the traditional consumer financial protection frameworks that exist need careful revision and don't necessarily all adequately fit the new world order. So to me, this is an area where as if I were a financial regulator, I would be investing a lot of time is in ensuring that there are the necessary resources there, you know, installed to think about protection of the retail investor, especially as these become means that are used in less as pure speculation vehicles, but more as vehicles for, you know, conducting day-to-day life, investments, payments, insurance, gifts, and so on.
Absolutely.
Matthew,
Yes, Anna,
may
please.
I chip in?
Please.
I want to echo the comments of Robert and Blythe, but especially from a regulator's perspective, one thing that needs to be done in many, at least in many emerging markets, which is the main target of the World Bank, is to review the legal and regulatory frameworks to ensure that financial regulators do have the powers to act over certain sectors of fintech. And here, what I'm talking about is precisely to expand the perimeter of regulation. So that's first, because in some countries, they do not have this authority today, so it has to start there. But the second point, echoing what Blythe is mentioning, is that indeed, there needs to be in some cases an expansion of the perimeter of regulation to bring them also into the application of licensing, for example, processes that therefore through the licensing, you ensure that the fintech have certain fit and proper requirements, that they have certain robustness in their platforms, et cetera, but also that you apply consumer protection rules. And I do agree with Blythe that this cannot be blindly, that this has to be proportionate and tailored to the sector and to the risk that they bring to the system. But so again, it's about expanding the perimeter of regulation, expanding depending on the fintech issues like the licensing regimes, the consumer protection rules, but understanding very well what the sector is so that there's not a blind application of the rules that you have, but more of a proportionate application.
Excellent. And I just want to round it out, John. A lot's been said already. Anything further to add?
Certainly, there's a lot of international work on standards on consumer protection. I think that it's very important to make sure that those standards are widely applied across the sector and to different providers doing similar activities.
Thanks, John. So I want to start bringing in the questions from participants here, and we've got a number, so we're going to try to sort through this. Perhaps sort of reflecting on the regulatory perimeter here and the intersection between fintechs and incumbents. What are some of the developments that you are seeing in terms of new partnerships or perhaps competitive opportunities there between fintechs and incumbents in this COVID environment? Anything that is strikingly interesting and new that we're seeing out of that interconnection? And this is an open question to the group, but maybe I'll start first with Blythe, and then we can pivot on.
So I mean, I think there was a debate which started, probably 5 or 6 years ago, as to whether fintech was a threat or an opportunity to incumbents. I always felt that was a gross oversimplification of the reality. It's a much more nuanced set of relationships, and the reality is that the very best companies learn from threats. And also have the opportunity to partner with providers of new technologies to leverage those or to develop their own capabilities to respond to them. And I think over the last 5 or 6 years, you've seen exactly, both of those happening. So you've seen plenty of examples of mainstream incumbent financial institutions embracing the technology of fintech providers, making strategic investments in them or outright acquiring them. I'm just randomly picking them out of my head here, JP Morgan's relationship with OnDeck, or Banco Santander's acquisition of eBury. I mean, there are countless such examples. Equally, many of the major bank and non-bank financial providers are using the raft of new modern technologies that are coming of age simultaneously. So this is, cloud deployments and API interfaces and new open banking and similar regulations that are opening up opportunities. The deployment of AI, machine learning, even the pending arrival of quantum, practical applications of quantum quantum computing technology, big data. All of these things are a bewildering array of capabilities, some of which have been advanced by new smaller fintechs, but all of which are now available to everyone. And so I think we've seen plenty of cooperation and partnership. We've seen acquisitions and we've seen new builds. So, we've seen incumbent banks, again, just to take an example, a Santander, who's been a retail banking giant for as long as anyone can remember, has developed a fully digital native banking platform called Open Bank, which uses all of those technologies that I've just rattled off, with the possible exception of quantum thus far, which is potentially disruptive to its own activities, but certainly is very much embracing of and highly competitive with other incumbents, and indeed was an activity that performed exceptionally well during the financial crisis, reinforcing the point that if you as an incumbent have developed a digital strategy that transforms your existing business in the direction of greater digital engagement with your customer, it does not mean that you're destined to lose all of your customers to those that are digitally engaged with them. The banking industry is a massive spender on technology. In fact, financial services, which includes insurance as well as banking and others, spends $800 billion a year on technology every single year. That's 1 in every $4 in the world that are spent on technology are spent by financial services players. And a lot of that is them doing it themselves, as well as using services provided by fintech vendors. So I would say this is a space that is a complex mix of threat and opportunity. But by and large, I don't see any sign of the incumbents being eliminated through the arising digital threat.
Thank you very much. Bob, I know this has been an area of deep interest and study on your side. I would like to have you come in too. I just want to give everyone a signpost here. Really interesting question. I want you to ponder it, put it in your memory banks. We're going to come back to it from one of our participants. So, and this is from one of the fintechs that participated in the survey. And the question is, I'm going to read it verbatim. If there was one thing that fintech companies should do now, what would it be? So I want to come back, Bob, to you on this intersection between traditional financial services institutions and fintech to expand upon Blythe's comments if you have more to add there. But I wanted to plant a seed in everybody's mind about that one thing fintechs should do, because I want to come back to that question, a very interesting one. Bob, anything further to add?
Yeah, it's a tricky thing. I mean, I mentioned APIs earlier, right? And if I take a look at a model in Asia, for example, like Apex, which is essentially a platform which has developed an API to facilitate the easier integration of fintech applications with incumbents in the region. Those are the kinds of moves that fintechs have to support going forward. It's a tough question to answer. There's no easy off-the-shelf, what would I do in 2 weeks? It's about recognizing that there is value in collective effort, I think, to solve some of these, they're not public good problems, but they're common fintech industry problems, like common APIs. We heard about common standards that John mentioned before. Take a look at the RegTech industry as a subset of fintech. Just the fragmentation of approaches in how you represent regulatory information is inhibiting large financial firms from onboarding the offerings of those fintechs. No matter how innovative they are, if you can't interface with the technology infrastructure of your customers, it's going to be very, very challenging. And where that kind of self-convening has been effective has historically been in the UK versus, say, the US, where the industry, I saw the lending industry, say 2010, 11, 12, got together. In that case, it was engaging with the regulator with one voice that achieved things that were not able to be achieved. So there's collective benefit in collective effort, I would think.
Thank you. And I noticed you nodding your head in agreement. Anything further to add on that?
No, just emphasize that from the World Bank perspective, we're always interested on the policy side, and precisely the point that I wanted to bring is the importance of fintech knocking on the door of the government authorities and the financial regulators, and having on their side one voice, so that regulators understand what their needs are and are better able to act on them. And with this, I wanted to bring a point that came from the survey that to me was a very interesting, somewhat surprising finding, which was that at least actually in both emerging markets and industrialized countries, but more in emerging markets, what fintechs were asking in the short term was more of straightforward regulatory measures. They were asking for two things. On one hand, please streamline procedures, streamline your regulations to bring new customers. eKYC, remote onboarding, simplifies due diligence. And on the other, this was more in emerging markets, please give me faster authorization processes, faster approval processes, exemptions. And when we look at these against the regulatory survey that we did also with the Cambridge Center, regulators, financial authorities were very aware of the first type of measures and were acting on them, particularly on the digital payment side. We saw, and Tanya was mentioning, that a lot have been done by financial regulators to streamline eKYC, to streamline remote onboarding. So that's an area that they have in their radar and they are working on it. Although in some emerging markets, this requires further cooperation, because all this has an underpinning. You need to have good digital ID, biometrics infrastructure, but that is in the radar. But then the other side, when they talk about the need for faster approval processes, none of that, at least explicitly, came from the regulatory survey. It didn't seem to be on the radar of regulators. And so to me, this is just one example of exactly what Bob was saying. First, what I would recommend is you need to make your concerns heard and clear, and that could also allow government authorities and financial regulators to act on them.
Thanks. Anna, one of the areas I think that is a quintessential example of the tension between the regulatory community and innovation more broadly is in the stablecoin space. John, I know you've done a lot of work around the evolution of CBDC and stablecoins. Can you give us a bit of a sense on what the medium and longer term perspective is with respect to stablecoin development and how that may have implications for the broader fintech ecosystem?
Sure, thanks. So there's certainly a lot going on around stablecoins, and just as a recap, so stablecoins are a type of crypto asset whose value is pegged to fiat currencies. So there are a number of examples out there and a number of relevant proposals that are in the pipeline. There's been quite a bit written about the regulatory concerns around stablecoins, the incentives that issuers face, some of the potential implications for monetary policy, financial stability, for AML, CFT, and for other things. But there is, of course, also some potential, and regulators are discussing this actively. Where can stablecoins be used? And what do they bring relative to other digital offerings? And Matthew, you mentioned CBDCs. So there is this open question, can central bank digital currencies, which would be issued by the central bank rather than by private issuers, offer similar functionalities, building on the existing institutional underpinnings of money? And there are a number of central banks that have communicated publicly about their work on central bank digital currencies. There's a lot of research and experimentation going on currently. Research at the BIS has also done a stock take of these efforts and looked at the drivers. So why is it the central bank digital currency projects are more advanced in some countries than others? And one of the things that's been found there is that CBDC projects are more advanced in jurisdictions with a higher innovation capacity, so where there may be a higher demand for these types of products. And indeed, a number of central bank digital currencies could offer new functionalities, new possibilities to embed a digital representation of value into distributed ledger technology or into other applications. But what's important to emphasize is that many central banks are considering a model where the private sector and private sector intermediaries still have a very important role, even in these central bank digital currency projects. So there would still be an important role for banks and for non-bank payment service providers to offer services on top of a central bank digital currency. And there's a lot of work right now on what that would look like in practice. Again, this has been something that's being coordinated internationally and where central banks are aiming to learn from one another and from each other's experiences.
Thanks very much, John. So we've got about 5.5 minutes left here. I want to keep pushing on the questions as much as I can, just leave about a minute for just closing reflection there. I want to stay on the digital asset theme, but I also want to remind everybody, and I think Anna and Bob have already chimed in on the one thing that a fintech can do, realizing that it's difficult to sum that up in just a few words. But Blythe, I'd like to also hear your thoughts, and John as well. So I'm going to come back to you on this. But coming out of the survey results, we saw a pretty significant year-over-year growth in digital asset exchanges and digital custody. Blythe, maybe this is an area obviously near and dear to your heart. Perhaps you can help illuminate why these different fintech clusters are doing so well at this point in time.
So, obviously, the answer is that there has been a significant increase in adoption of the use of digital assets. So that's why these digital asset exchanges and custody verticals are reporting growth. The harder question, of course, is, why is that happening? And I think that there are probably at least 3 distinct reasons for that. The first one is, and it is not, in my view, because cryptocurrencies, for example, are yet anything like fulfilling all of the promise needed for them to becoming definitively meaningful alternatives to fiat currencies. To be such, you'd need to be a store of value, a medium of exchange, a unit of account. And many cryptocurrencies still fail on one or more of those criterion, although obviously the advent of fiat-linked digital currencies addresses some, but not all of those requirements. I think, though, that what is driving increased adoption can be thought of along three lines. Number one, there's an element of investor speculation at play. Number two, there are some maturing use cases where the decentralized finance technology makes sense. And number three, there's been a fairly significant expansion of digital custody capabilities that bring these asset classes much more into the mainstream. So on the first front, investor speculation, clearly in a world where there is potential for anticipated inflation in the future, although the world's economies remain slack today, there is widespread concern that the monetary and fiscal responses to that will eventually come home to roost, and there are limited assets that diversify away from the risk of rising inflationary pressure. You've seen retail investors speculating. I think over 8% of Americans now own or have owned Bitcoin. You certainly see evidence of use of cryptocurrencies in jurisdictions where there's significant financial disruption, such as Venezuela. But you're also seeing institutional investors taking an interest, and these are the same investors that are also looking to invest in gold and are looking around for alternatives to the conventional asset classes, which have a lot of money chasing them. So I'd say that's one driver. And I think it's impacted by the overall macroeconomic and financial monetary condition environment. Maturing use cases, so decentralized networks that serve financial services needs, saving, lending, insurance, trade processing, loyalty points, other forms of points. These have seen also a very significant increase in value, more than 10 times, probably closer to 15 times increase since the beginning of the pandemic. And I think that what that is reflecting is maturing of the technology, wider spread understanding, new capabilities, and people spending more time at home and getting involved in things that they didn't previously have the time to play with. And then the expansion, on the last point, the expansion of digital custody, the fact that the likes of Fidelity and other established institutions, including banks, are now offering custody services as a means of differentiating their offerings, has meant that those that have fiduciary responsibility to others, to their investors, are in a much stronger position to think about participating in digital asset markets without exposing themselves to the reputational and financial risk associated with very poor operational infrastructure, which traditionally has surrounded the space. So I would say, that increased regulatory clarity and increased availability of services is also helping. So those would be the things I would point to.
Thanks very much. So I realize we are up against time, and there's so much more really to go through here. The report will be coming out on the 3rd. It's a terrific body of research. I want to thank our panelists here today. We covered a whole host of different topics from a number of different vantage points. We could not have done that without your great expertise. I also want to thank our partners at the Cambridge Center for Alternative Finance and the World Bank Group for such a terrific collaboration over the past months here. And we have another phase of this that will be starting in earnest, and that's extremely exciting. And we look forward to continuing that collaboration going forward. I wish everyone very good health and best wishes during these very challenging times to all of you and your families. And thanks again for spending the time with us this morning. Have a great day and a great week.
Thanks, Matthew. Thanks, everyone.
Thank you.
Thank you.